Hello, hello, hello. What's going on, everybody? Welcome to a Capital Hungry lecture and educational webinar on understanding market psychology and market waves, as well as the second half of this webinar will be some market analysis and trade ideas as per normal. It looks like everything is good in YouTube land, so I'm just going to jump right into the lecture portion and educational portion, and then we'll do our trade ideas and analysis afterwards as well. But it's always good to continue to learn more, understand what's going on in the real world that impacts the markets, and understand how much human nature plays a part in these man-made markets. I'll let the chat handle any trolls. I'm just going to go straight information mode because I have a meeting, an appointment that I have to get to at 5:30, and it's 4 o'clock right now. So I don't want to waste any time, as the educational webinar might take a little bit, like 30-40 minutes, and then we got to do the trade ideas as well. Okay, so understanding market psychology. When I'm talking about market psychology, I'm not talking about your personal psychology, such as your own risk management or your own emotional control while trading the markets, day trading, scalping, or whatever it may be. What I'm talking about is the psychology behind the order flow and movement of these man-made markets, where human nature plays a major role in how these markets were created, how they function, and how they move to this current day. Even with a lot of the trading becoming algorithmic, these algorithms are still designed and programmed, maintained, and kept by humans, right? So human nature will always play a major part in dictating order flow, various events that occur in the world, from wars to political disputes, and how it impacts the financial markets down the line. What I'm going to be explaining to you is the impact of human nature and psychology to the markets, using the example of stock markets for a very specific reason. I'm first going to tell you the core concept of the stock market and how human nature plays such a major role, and then factors that prove this over the course of the last year and a half, 2 years, through the pandemic phase. So let's break this down. Market psychology. Topic of how human nature impacts the markets. Example, global stock markets. Now, we have to understand that global stock markets are man-made and designed to go up in value. That is the whole creation of the stock markets, as it's primarily linked to corporations and businesses involved in various industries within a country's economy. One of the main signals towards a recession or slowdown in a country's economy is when their respected stock market is no longer continuing to print higher highs. You're starting to get a shift with the stock markets turning more bearish. But we have to understand that the stock markets are connected to central banking, institutions and banking down the line, corporations and businesses, to citizens as well, through jobs creation and so forth that are linked to the corporations and so forth, and majority currencies and everything as well. Overall, these global financial markets are heavily interconnected, and way too much around the world drives on the health of the global stock markets, and understanding that besides the periods of time when we have a crisis, the stock markets are always bullish. Higher time frame bullish, designed to be more bullish, and increase the wealth of the 1%ers that are heavily involved in the stock market, increase the prosperity and wealth, as well as the power and resources of the corporations that are involved in the stock market, and of course heavily connected through the credit allocation from central banking, the funding and money injection that occurs from central banking and institutions, and how they're obviously all interconnected as well. So this isn't any type of chain of events where we're saying the stock market is bigger than central banking. No, all of these are interconnected and work hand in hand down the line. And you have to understand that from the institutions and corporations down the line, this is where you primarily get all of your jobs that are created in industries, employment sector, and everything else down the line. Consumption, retail activity, manufacturing, etc., etc., right? So you have the central banks, which are primarily designed to maintain the money markets and monetary policy, as well as the economy of the respected economy or country that they're looking after. In the example of the Federal Reserve is the one setting the interest rates down the line, the amount of US dollars in money supply, whether through their monetary policy, they're very hawkish or keeping monetary policy tight, or they're dovish in keeping monetary policy very loose. This has an impact to how the institutions adjust their order flow along the line, how corporations, and how it impacts one percenters' wealth overall as more jobs get created, more consumption, retail activity, and so forth. So all I'm trying to make you understand is that everything from our jobs, from what we purchase, from import and export, from corporate profits, institutions, and central banking to one percenters' wealth is interconnected into these global stock markets. So we have to understand something here, that these stock markets are man-made and heavily derive based on human nature, and especially understanding the human nature factor of greed. Now, who are the primary main major participants involved in the stock market as it goes up years over years, and besides any crisis period where every single economic crisis has been nothing but an opportunity created for the wealthy and rich? It's the one percenters, the wealthy, the people on top of the corporations and institutions that primarily benefit off of the stock markets, not your day-to-day consumer, not your day-to-day worker and citizen, right? So what we have to understand is that based on human psychology, when we understand that these are man-made markets designed to go up in value and increase the wealth of the participants involved, where it's very important understanding that the participants involved are the people who run our world. From banking to big pharma to big tech and any other aspect of industry within a society. The reason why Elon Musk and Jeff Bezos are so extremely wealthy and have valuations of being worth in the multiple billions and billions of dollars is not because they have that much liquid cash. It's because their wealth is attributed to the stock market value of Amazon or Tesla or the other businesses that they own and that are attributed into the stock market, right? So the participants that are involved in this game that's essentially rigged, and the ones who benefit off the most are also the people who have the most power within our society. These huge corporate CEOs, these people running the industries from energy, oil, big tech, pharma, food, consumer items, and everything else in between, right? So this is very important to understand because it has a direct impact on how price moves within the markets. Whenever you have the stock market going bullish, especially with the support of the central bank and a lot of catalysts that make the investing environment so favorable, it is extremely easy, smooth, and steady upside. Because that upside, whatever the fundamental catalyst is, and I'm going to give you an example when we look at US 30 in a moment, that fundamental upside supports the agenda of the people who run the world. It makes them even richer. It extends the value of their wealth. It makes their corporations and businesses worth more. It makes them earn more money as well, right? Which gives them more power, control, and resources in the end, and extends their wealth and power through the generations to come. But having market crashes or corrections or bear markets unless it's induced by a major detrimental fundamental catalyst, with one of the outliers being the global lockdowns we faced in 2020, of course, which was a major historical event. The anatomy of when the stock markets are in a bear market or asset classes are going down is completely different than the structure and anatomy of when you're going extremely bullish. And I'm going to give you guys some examples of this when we're looking at US 30 now. So let's look at US 30 here on the daily, right? Now, this was a crash that was induced by obviously a fundamental catalyst that was a historical event, which was COVID, but not just COVID itself, the coronavirus, hopefully I don't get flagged on YouTube, leading to governments shutting down economies and making them stagnant. Whether you want to say this was a planned event, whether you want to say it was set up, that's all up for speculation. But at the end of the day, looking at the financial markets, it does set up an opportunity for the people involved in the markets, just like every single other economic crisis and collapse. Now, the cartel of the currency, the Federal Reserve, they came into play here as the market was collapsing and crashing, and they did not want to see any other downside. They wanted to prevent a type of depression or a full market crash. And they have the tools and resources at their disposal to do that, alongside working with the corporations, institutions, and whales down the line. Why are they preventing a crash? And why are they not allowing the stock market to drop any further than this specific point? Because remember how much is connected and interconnected globally to these stock markets, from the corporations, the banks, the other institutions, people's jobs and livelihood, small businesses, debt, loans, and every credit and everything else down the line is heavily interconnected within these financial markets. So the cartel of the currency, the Fed, hits the circuit breaker, stops any more short selling, exponentially increases money supply, rates at zero, and starts pumping the markets in layman terms. Pumping the markets is their asset purchase program, QE, credit allocation to the corporations and institutions down the line, and loans given out at 0% interest rates that just gets reinvested into the markets, right? So even though you have to understand the manipulation in human psychology involved of how greed takes over, during this period of time for the general masses, from 2020 through the next year and a half, this was major panic and fear. This is when news headlines were flooded with all the fear around COVID. People were trapped in their homes and locked down. Everybody is being distracted to focus on something else, whether it's COVID, the vaccines, the lockdowns, what's going on with the world shutting down and people going crazy in grocery stores fighting over toilet paper. While that was happening in the public face, behind closed curtains, behind the doors, the major money moves were going on behind the scenes. Now, we have to understand something, that the Fed's hitting the circuit breaker, having rates at zero, exponentially increasing money supply, in the short term there, that devalues the US dollar during that short period of time of around 6 to 8 months, and also increases economic inflation. But remember the definition of inflation. Inflation is very simple to understand. Whenever you have an increase in economic inflation, everything within that economy increases in value. Now, inflation increasing to a certain extent is actually positive and beneficial for the 1%ers, where the majority of their wealth is attributed to owning asset classes. During this period of time, when the Feds started pumping the markets, started extending the free money era, started giving credit allocation down the line, QE, interest rates at zero, majority of asset classes were bullish. The stock market was extremely bullish. The real estate market was extremely bullish. Crypto was extremely bullish. Commodities were extremely bullish, all for the same exact fundamental reasons, right? So here you have multiple reasons and catalysts that support an extremely beneficial investing environment for the 1%ers and for the rich, even though you have all this mass panic and fear to the public. Why is this such a beneficial investing environment? Well, think about it. You have extremely low prices being set up due to a global crisis catalyst on stock markets, on real estate, on crypto, on commodities. You have interest rates at zero, which has more institutional investment activity of these major banks and corporations taking out more loans, taking out money from the feds at 0% rates, and investing that money right back into the stock markets, riding the wave with the feds, the cartel of currency, pumping the markets essentially as well through asset purchase program, quantitative easing, and credit allocation. And you also have an increase in inflation, increasing the price of everything within the economy. This is the main reason why the stock market was so extremely bullish, even though you had all this major panic and fear that was going on for the public and general masses, right? And look at something very specifically. Remember market psychology. Whenever you have the stock market and a very strong investing environment that supports that main human nature of greed, look at the stock market upside. Very minimal pullbacks, continuous upside all the way until higher highs are peaked. Until these all-time highs were peaked, right? And in reference to the current price point we're roughly sitting at now, which is pre-COVID crash point. Look at how smooth and steady, even after we broke above the pre-COVID crash point, this upside was, right? And look at how the investing environment completely shifted on its head, because remember something, as everything has an expense or cost, nothing comes for free. Sorry, I moved my camera out of the way. Everything comes at a cost. Nothing comes for free. The cost of that massive money printing and increase in money supply, pumping of the markets, the whales riding that wave, huge amounts of wealth created through that 1.5 year period while the world was in major panic mode and the people suffered, the cost of that was extremely high risk inflation, right? So the Federal Reserve, the cartel of the currency, the same time the feds got banned from trading the markets anymore, you saw the feds completely shift this beautiful investing environment into something that goes against the human nature narrative of the 1%ers. Now, instead of low prices, you have all-time high prices on asset classes. You have feds starting tapering. Instead of low interest rates promoting more investment activity, you have hiking of interest rates. Instead of whales continuing to pool in more money into this, whales now, after having a huge amount of wealth generated over the 1.5 years, they're cashing out. And because of the Fed shifting their monetary policy, USD domination comes back into the scene with dollar bulls. But look at the difference in the anatomy of market structure when you're going against that main human nature narrative of the stock market being bullish. For the same amount of price movement from about 29K to 36K, it's completely night and day difference. Yes, overall, we're trending to the downside due to these fundamental catalysts and the shift in, of course, investing environment induced by the central banking, an inevitable shift in market cycles, entering a recession, having to combat record high inflation, and of course, the US dollar domination. Yes, you still have sellers print these consecutive lower lows, but you have monstrous, delusional bear market rallies before seeing a continued leg down. What is going on here is that every single time a significant low is printed, there is some type of fundamental delusion to potentially give the chance that we're going to be going back to all-time highs. And what this also does is trap enough buy-side liquidity in these delusional rally phases to see another leg to the downside, right? This type of understanding of market psychology and market anatomy is very important and understand to how you adapt to waves, adjust trade ideas, and play the markets accordingly. Because take a snapshot of this and really study it. The same fundamental reasons here why stock market was so bullish is the exact same reason, if you go and backtest, why crypto was so bullish at the exact same time. Why gold turned so bullish and went to $2,000 an ounce. Why the real estate market was so bullish. And the corrections we've seen with gold going from 2,000 all the way to 1,600s, stock market going from 36K down to 29K has been for the exact inverse reasoning stated here. All rooting down from the cartel of the currency, primarily being the central bank, as they dictate and rule over the world reserve currency being the US dollar, the global business currency being the US dollar, right? So this information here, it's not just impacting the US equities. This human nature and psychology, understanding these fundamental catalysts, market cycles and market waves, how a crisis impacts order flow behind the scenes, it's the same type of impacting factor when we go and look at gold, right? So understand that when you have asset classes pushing more bullish, increasing the wealth of the 1%ers, the Fed supporting that sentiment as well, it was very easy and smooth and steady upside. And when you have downside in the stock market going against that 1%er agenda, but being inevitable because market cycles and what goes up must go down is a part of human nature as well. But that's not the reason behind it. The reason behind it is inflation became way too out of hands, where the Fed completely started stopping the support of the the central bank, the Fed, completely stopped the support of the stock market and shifted their investing environment from a very dovish, loose monetary policy to hawkish now. So now, instead of the low prices we had here, money supply being injected to the markets, rates at zero, pumping of the markets with their asset purchase program, quantitative easing, and then the whales and institutions riding that wave, we're completely flipping that all on its head. Now we hit all-time high prices. Feds are stopping the money printer and starting the tapering process, increasing interest rates, primarily focusing on combating inflation, whales cashing out after a huge amount of wealth generated over that year and a half, dollar domination back into the scene. But what I'm trying to explain based on human psychology and nature is the downside in the stock market is not going to be the same as the upside until we hit major institutional panic and fear and see panic selling ensue, right? Let me show you something very important here as well. Let's go look at US 30 on 2008 global financial crisis. Right? This is 2008. This is not even what I'm looking at now. And look at the difference when you had the stock market rallying bullish versus here, which the fundamental catalysts were different, but the anatomy is the same. When the stock market was trending bullish prior to the 2008 financial crash, just straight upside, minimal pullbacks all the way until you cannot peak any more all-time highs. As we started to get the uncertainty developing into the 2008 global financial crisis, you can see the downside market waves saw multiple delusional relief rallies until you finally had the crisis set in place and that panic selling ensue. But for almost a year, as the stock market was going down in value, you had these very, very aggressive waves taking place. Waves that are no different to the current bear market we're seeing now. Right? So, understanding these market waves accordingly and understanding how it even impacts other asset classes such as gold. Let's look at gold here as an example. When you look at gold's upside, it was extremely, extremely impulsive. This was that March 2020 point. This was the same fundamental reasons that you're hitting historical lower price points on gold. You're just at the 1440s. You have mass panic and uncertainty with global lockdowns bringing more demand into gold. You have rising inflation that's just starting to rise with the exponential money printer of the Feds, low interest rates, and of course the institutions riding that wave. Very impulsive upside from March to like August, going from 1440 all the way to 2080 an ounce. This is when Feds had interest rates at zero, money pumping into the market, asset purchase program active, stimulating of the markets in a loose, dovish monetary policy. Compared to when the Feds finally started to raise interest rates and you have a completely different investing environment. You have gold at all-time high prices. Fed stopping stimulus, tapering, raising interest rates. And you see, yes, gold has had beautiful downside that we've been tracking from 2000 an ounce, but look at the timeline difference. It's almost taken a year plus just from gold to have way less downside compared to the upside. That upside we were looking at with all that investing catalyst I'm talking about and fundamental catalyst, you had gold go from 1450 to 2050 an ounce, right? $600 an ounce in the matter of 3-4 months. And here, almost coming to a year point now, we've seen gold, yes, it's been seeing this consistent downside. Yes, we've been going down in overall price, but these consistent market waves to trap buy-side liquidity in the market as a lot of the fundamentals in the short term get priced in, and you can see these short-term market waves occur before continuing another leg down, right? So understanding that market psychology is extremely, extremely important. Right? Now, let's understand these market waves even more importantly when we're looking at gold. Gold has been extremely bearish. And what I'm seeing with this pullback is nothing out of the ordinary, and let's dissect this order flow accordingly. So, gold has been extremely bearish on a macro higher time frame perspective for the reasoning stated here in red. Right? Overall, we see that the more prominent moves are gold sellers printing consecutive lower lows, having these short-term pullback phases as these lows are printed, with sellers liquidating positions, buyers jumping in to provide that extra relief, and also trapping a lot of buy-side liquidity in the market. But as soon as you start to reach another significant sell zone of interest and institutions can get better prices, you just continue the higher time frame trend. Now, I also want you to look at something else very important. Whenever you revisit a previous low marked in these yellow arrows here, you can see that you usually can notice that you get an extended, deeper pullback phase compared to normal. And this also makes sense as we're potentially setting up price for November FOMC to come. Let me give you an example, right? So here, beautiful downside move, beautiful stretch to revisit previous lows. But as you revisit these previous lows, you have an aggressive pullback phase to generate more sell side liquidity before continuing the trend. Here, this sequence of events here, sell low printed here, beautiful downside move to revisit those lows, but you don't instantly break, get an aggressive pullback phase before continuing the overall trend. Here, beautiful downside from 1800s to 1680s. But as you revisit these previous lows, you don't instantly break. You get a deeper pullback phase before continuing higher time frame trend. Here, beautiful downside that we've called and played with the retest of 1720s to at least revisit previous lows at 1620s. But we did not have enough seller order flow to break, and we also had fundamental catalysts come into play here. China and Japan currency interventions to prevent how aggressively dollar is pushing to the upside and devaluing their currencies. Right? Hopefully you guys can read that. I think it's cut off, but it says China, Japan currency interventions. But understanding order flow, the sequence of events is the same. We could easily just get what is completely normal, and we've seen time and time again that I'm going to show you in this pink box before still continuing the higher time frame trend. Right now, we're sitting in pretty much this type of market structure area, as seen time and time again, right? Unless we have fundamental catalysts for gold upside. This arrow here, only reasons for gold higher time frame upside to invalidate macro information advantage marked on the screen, and breakout trend, right? Those reasons would be a Fed pivot. Fed's completely reversing the rate hikes, going back into a stimulation mode. China physically invades Taiwan. The US interferes physically with Russia and Ukraine, which they probably won't do, but if they do, and sends physical military and starts to escalate into World War III. Or we have another type of catalyst that brings global uncertainty, like lockdowns round 2. I don't know, right? Unless we get real world fundamental events that can overpower or invalidate the Fed rate hike cycle, having these types of pullback phases, corrective phases, and secondary phases of market structure is completely normal, especially when you understand the human nature and psychology of the markets, right? Having these bear market rallies in equities, the same time we're overall very bearish, is completely normal. Trapping the buy side liquidity, stock market buyers thinking the bottom is in, whales generating that liquidity for another leg down. All I see right now is price doing a pullback, setting up better price points of interest, and dollar buyers also setting up better price points of interest to set up for the November FOMC, where I think the Federal Reserve is going to come out and say, hey, we're still going to be doing the same shit. We're still going to do more aggressive rate hikes, keep rates extended for a period of time. Inflation is still high. The last employment report was good. We have no reason to stop rate hikes yet. And then you're going to see this entire upside move corrected, go back down to 1620s, and continue this beautiful, beautiful bearish trend, which is induced by this fundamental information advantage, which is the exact same reason why crypto is bearish right now, stock market is bearish, real estate market is bearish, commodities are bearish. Right? And the delusional rallies, the pullbacks, are way more aggressive in the stock market to create all of these false bottoms. But overall, we have to look at market structure. Every single pullback has still come from a significant lower low being printed. And whether the pullback is large, it doesn't break overall broad bearish market structure, and the moves still get faded out, and we have what is called taking the stairs up versus the elevator down. The pullback structure or secondary phases of market structure can always be a lot more choppy, see a lot more sporadic movements in lower time frame within it. But as soon as the sellers come back into play with the main macro information advantage, you are taking the elevator back down. All of that buy side liquidity getting trapped into the market, sellers driving down, printing new lower lows. we could see equities have a short-term relief rally and revisit 32K, 32.3, and still not break overall bearish market structure, understanding of order flow. And if the Federal Reserve, the November FOMC, still keeps the same mandate and still talks about combating inflation, keeping rates up for an extended period of time, no slowdown in rate hikes, all we're going to do is fade out that move like we've done 4, 5, 6 times. And understand that because of human nature and how heavily interconnected it is into these financial markets, which are man-made, history constantly repeats. An average bear market on the stocks, right? Whether it was a 2008 global financial crisis, whether it was the year 2000 dot-com era crash, whether it was the 1980s market crash, on average, there's 6 to 8 delusional false bottoms in bear market rallies. And we've seen 6 so far, with this being number 6 primarily. So this is still lining up with the bear market understanding of order flow through history. It's still respecting overall bearish structure, and it's not like we haven't seen these waves before. But to think that the stock market is going to go to all-time highs without the Fed actually confirming pivot is impossible. And I know, I'm not here to be like, oh, I don't support a Fed pivot. I'm just thinking the Feds are going to hike rates. I don't give a shit. You guys have to understand, I have a great economic understanding. The US economy down the line is fucked regardless. Either they're going to deal with a huge debt crisis with interest rates being extremely high and the focus being on to combat inflation and them not being able to pay back debt, and overall recessions developing further and the economy's crashing or having a deep recession from that point, or the Feds are going to pivot, go back to pumping the markets in the short term, and then inflation is just going to continue to rise, and you're going to have an inflation crisis down the line anyways. Right? Thanks to the human nature of greed and how far greed was exploded over the last 2 years during the pandemic, the Feds are damned if they do, damned if they don't. The economy's fucked no matter what path it goes on. It's just about how are they going to handle this inevitable downside. You're either going to have an inevitable debt crisis if you continue to raise rates and keep them raised for an extended period of time, or if you don't do that and you pivot and you start pumping the markets again, yeah, the stock markets will go bullish and back to all-time highs with a full Fed pivot confirmed, but that's not going to last that long until hyperinflation or overall high-risk inflation starts to destroy the economies. Right? But for the time being, the Feds have not confirmed any pivot. Every pivot rumor has been completely faded out. The economic data is still showing us inflation is high, and Fed interest rates have had yet to actually impact inflation or trickle down to the economy. US dollar still extremely bullish, and this is just looking like a price setup, creating a beautiful range to revisit these lows to set up for the November FOMC to come early in November. Same thing with the pullback we're seeing on gold. Gold is still extremely bearish. Same thing with the higher time frame or pullback on GU. Yes, we can pull back a bit further, but we're still extremely bearish on the higher time frames. And same thing with EURUSD. But we are manual retail traders, scalpers, and day traders. Us having this knowledge, we can go, all right, you know what? Even though EU is bearish on the higher time frames, EU can still go up to 1.0 flat, 1.02, and still continue the overall higher time frame trend. In the short term, if I see the equities relief rally continuing, if I see US dollar short term bearish, I'll play these pullback buys to set up better higher time frame sells. Same thing with gold. Gold can come and retest into the 1680s still and set up for November FOMC and still be very bearish. If you notice the relief rally on equities continuing, gold bullish intraday price action, dollar still bearish, we'll adapt and play those short-term buy phases until we jump back into the higher time frame sells like we have for the last year. But having this knowledge, having that understanding allows you to adapt to the various market waves, not lose sight of the macro image, and then still be able to jump into the main higher time frame trend. Because When the feds come in November, and if they don't change anything and they're still looking to combat inflation and dollar turns bullish again on the higher time frame, you don't want to be missing this nether bearish leg down. Does that educational lesson and lecture on market psychology, market waves, and market phases make sense to everybody in the chat? Yes, if the feds keep doing what they're doing, which has already been talked about in the dollar domination webinar done by Capital Hungry Analysis Sebastian, then we're going to see other countries do more currency interventions to decrease how aggressively their currencies are devaluing, right? Okay, now the lesson's over, the lecture's over. Now let's jump into the trade ideas, okay? And understand something very important now as we jump into the trade ideas. Now, first, the fundamentals. Markets are in secondary phases of market structure, either in pullbacks, corrections, or consolidations. Example, like I stated, is gold is very easy to understand fundamentally and technically bearish on the higher time frames, but it is very common that as we revisit previous significant lows, we don't always instantly break and can get these aggressive pullback phases before having enough liquidity to continue the overall bearish move down and setting up better price points of interest, which this looks like it's going to be a FOMC price setup, right? But overall, we're in a secondary phase of market structure. Now, remember the anatomy of market structure. Whenever you're in a pullback phase, it's always a lot more difficult to play compared to the impulsive moves with trend, right? You can see the downside moves on gold. You'll have gold going from 1800 to 1600 in a couple of weeks, 1720 to 1620 in a couple of weeks. But these pullbacks can last weeks to almost months until you set up those better price points of interest, which we might see even here, some ranging and intraday indecision before another leg down. We have to adjust to that accordingly. But otherwise, markets in secondary phase of structure, pullbacks and consolidations. This is also being induced by short-term impact via currency interventions. Japan and China doing currency interventions last week and this week, all ready to start the new week. The Federal Reserve has a blackout period until FOMC. That means there's not going to be any reactive Fed speakers really until the next FOMC. Focus on economic data this week to add on to sentiment. Trading psychology tips. We have to adapt to market waves accordingly. Understand the difference in price anatomy of playing with the trend versus playing pullbacks. Do not overtrade, do not over leverage, adapt risk to changing market conditions. Market weighting. What's been holding the most weight? In recent times, it's been fresh currency interventions in the short term, risk asset relief rallies and pullbacks. We have central bank rate decisions, Bank of Japan, Bank of Canada, and ECB this week, and the US dollar being short-term bearish. What's not holding weight is Russia and Ukraine tensions is all noise. Taiwan tensions is all noise. Bank of England bond buying is all noise and priced in. The Fed hawkish remarks are so far priced in with no new events and a Fed blackout period. And a lot of the UK political tensions with Liz Truss being removed now has been priced in. In terms of sentiment, we're looking to play still US dollar weakness in the short term, just as we're having a pullback phase and potential price setups for the November FOMC to come. Japanese yen, even with the currency interventions by Japan, is still very bearish, and I'll show you that in a second. And the stock market's short-term relief rally, pullbacks to set up for November FOMC, or just retesting better price points of interest. We can see dollar, in terms of understanding market sentiment and dollar domination, is still extremely bullish on the higher time frames, but is just in some short-term pullback structure where dollar can easily still come retest 110, 108 and still be extremely bullish on the higher time frames. Pullback still coming from a significant higher high printed by buyers. Yen currency intervention or China currency intervention hasn't shifted the trend. No confirms of a Fed pivot, but I can see either dollar consolidating until FOMC or having a deeper price setup until FOMC before continuing more bullish. This can lead to deeper pullbacks on EURUSD, deeper pullbacks on GU, pullbacks on USDCAD against higher time frame trend, and also extending that relief rally on equities until we retest better sell areas of interest. Now, Japanese yen every single time has faded out the currency interventions. These were last significant currency interventions, and even the newer one we saw here already getting faded out. UJ and GJ are still very bullish on the higher time frames. We still want to play a yen bearish bias, but we have to watch out for these fucking pricks. They're still going to do more currency interventions. It brings a lot of volatility on the lower time frame, but majority of the times the moves get faded out as it cannot break that institutional order flow of the Bank of Japan from a macro perspective, still being very dovish, keeping interest rates in the negative and monetary policy very loose. When we're looking at equity markets, we're having these short-term relief rallies besides China markets, which is bearish for its own individual reasons. Now, when we're looking at gold here, I can see gold having short-term upside pullback phases to the 1670s, even 1680s, still setting up price for November FOMC before turning bearish again. I would look for short-term pullback buys on gold above 1657, 1664, potentially leading into better sells around 1675, 1680s, even watching a double top at 1650s or 1670, sorry. Otherwise, for me to jump back into higher time frame main bias sells, we would need to see dollar domination back into the scene, stock markets turning bearish, and break below 1640s and 1630s. Otherwise, I can see short-term pullback buys to better higher time frame sell zones, adapting to the secondary phase of market structure. On GBPUSD, similar type of idea, as majority of asset classes have been moving in singular fashion if you understand the fundamental impacting factors. If we hold above the key level 1.13, break above 1.38, I can see short-term pullback buys to retest better higher time frame sell zones, with the confirmations of dollar, when you're looking at dollar index, being bearish as well. Otherwise, I would jump back into the higher time frame sells if we can get range breaks below 1.116 and 1.108. Keep in mind, we're playing secondary phases of market structure with dollar consolidating, relief rally in equities, pullbacks against the higher time frame trend on pairs like GU and EURUSD, where it can be a lot more choppy and you have to adjust your risk and execution accordingly compared to when you're playing the higher time frame bias. EURUSD, similar idea here. I could still see EURUSD if we hold let me move this to the left so you guys can see outside the camera. 1.0984, break above 0.99. I gotta go to my appointment soon. And break above key level. If dollar is short-term bearish, we have a continued relief rally in euro equities and global equities. I could see these pullback phases easily to retest better supply and sell side liquidity zones. Otherwise, to jump back in higher time frame bearish trend, we would need breaks below the range, dollar domination back in the scene, and market sentiment confirms of the other asset classes and risk assets such as equities turning bearish as well, commodities turning bearish as well. USDCAD. Short-term pullback phases to 355 before better buys, breaks back above 3.8 and breaks above 3.88. UCAD still very bullish on the higher time frames. Oil still relatively soft, not seeing as much upside compared to some of the other risk assets. And still very bullish structure there. Got to keep in mind Bank of Canada rate decision. US 30. I can still see us having short-term buy plays as from the last market update webinar to 32.4, 32.5 handle before seeing us jump back into the higher time frame sells. Playing the relief rally and playing the pullback, but not getting trapped when we jump back into the higher time frame bias if nothing changes from a higher time frame and fundamental perspective. Last but not least, GJ. Still very bullish on the higher time frames. A lot of indecision that already occurred. If we get retests of key level 167.5, breaks back above 168.5, breaks above 169 and 170s, continue the buys. Keep in mind currency interventions that will just lead to short-term pullbacks and still continuing the higher time frame trend. No reason to sell GJ unless we're breaking well below 165s. Keep in mind tomorrow in terms of economic data, we just have some minor business climate reporting from Germany. It's not going to hold that much weight. Some business optimism reporting from the UK. Previous minus 21. Might see a continued little bit of pullback on GU and upside on GJ if improved. And then some consumer confidence data from the US tomorrow at 10 a.m. Eastern. Where if that consumer confidence is dropping as expected here, that can also add on to gold having pullback phases, dollar being short-term bearish as well. Nothing else really going on in terms of Fed or central bank speakers as we have the Fed blackout period and other central bank rate decisions later in the week. All right, everybody. So we went through a lecture on market psychology, market waves, market timing, fundamentals, and economics. We went through understanding what fundamentals are currently active, psychology tips, market sentiment, market weighting. Volume and volatility is relatively slower compared to previous weeks. Analysis and trade ideas across the board. I'm going to save and upload this. Hopefully you guys enjoy content like this. And if you guys want me to do this more often, if you want me to go back to doing the New York scalping live streams as well, make sure you send a like, subscribe, and share it around, and you can rewatch this as you wish.